If you think America's biggest economic warning sign is a bad jobs number, you're already looking in the wrong place. The real alarm is quieter and more dangerous. It's the moment the country can't even measure the jobs number at all. Because when the data goes dark, the economy doesn't stop. Power just moves. Here's what happened. A government shutdown interrupted the collection of key labor data. The household survey, the backbone of how America measures employment, unemployment, and labor participation, was not completed. That means policymakers, markets, and the public were suddenly operating with partial visibility. This wasn't just a technical glitch, it was a governance failure. In modern America, economic data is infrastructure. It's as essential as roads, power grids, and payment systems. When it goes offline, the system doesn't collapse instantly, but it becomes easier to steer without accountability. And that's where the real story begins. Because in today's economy, missing data doesn't create panic. It creates opportunity. Wall Street didn't freeze, it recalibrated. Political narratives didn't pause, they multiplied. And the Federal Reserve, the institution tasked with steering the economy, was forced to rely more heavily on estimates, models, and private indicators instead of shared public facts. That shift matters more than most headlines admit, because public data creates a shared reality. Private data creates an advantage. When official numbers are delayed or incomplete, power quietly shifts toward those who can afford better information. Hedge funds, large banks, institutional investors, political actors with selective talking points. Meanwhile, households are left navigating real life with less clarity and more noise. And this is where the economy's most uncomfortable contradiction comes into focus. Bad news has become good news. That sounds absurd, but it's not psychological, it's mechanical. Weak job data can signal a slowing economy. A slowing economy can reduce inflation pressure. Lower inflation pressure increases the likelihood of interest rate cuts. Lower interest rates inflate asset prices. Stocks, bonds, real estate, private equity valuations. So while layoffs hurt workers, they can boost portfolios. While wage growth slows, asset prices rise. The same headline produces two opposite outcomes, depending on which America you live in. One America lives on wages, the other lives on assets, and the gap between them is widening. Now add missing data to that equation. When labor data goes dark, markets lean even harder on expectations about the Fed, not on productivity, not on demand, not on wages, on rate cuts. This pushes the economy further into an asset-first mode, where prices are driven less by real activity and more by monetary anticipation. That's not capitalism breaking down. That's capitalism responding to incentives. And those incentives have been drifting in the same direction for decades. Let's talk about the consumer, because this is where theory meets reality. Officially, Americans are still spending. Retail sales exist. Services are being consumed. But underneath that spending is a fragile structure. Millions of households are no longer living paycheck to paycheck. They're living credit cycle to credit cycle. Credit cards, longer auto loans, deferred payments, buy now, pay later. These tools are marketed as convenience, but for many families, they've become survival infrastructure. Groceries, utilities, basic necessities. And here's the part rarely said out loud. Much of this consumer finance ecosystem isn't profitable. It's subsidized. Buy now, pay later firms burn investor capital to grow market share. Venture capital and private equity back the expansion. Losses are tolerated because growth creates valuation. Valuation creates exits. So consumers borrow to survive today. Investors fund the borrowing. Founders and early insiders cash out, and the system keeps moving forward without ever fully paying for itself. It's a loop, a fragile loop. And fragility is not evenly distributed. When conditions tighten, households feel it first, then small businesses, then labor markets. capital usually exits early. This brings us back to the shutdown and the missing data. Because when data disappears, it becomes easier to pretend the loop is stable. And pretending is powerful. Now zoom out. This isn't just about one report or one shutdown. It's about short-termism becoming the dominant logic of the system. Corporate America is managed quarter to quarter. Executives are compensated with stock. Performance metrics prioritize price, not durability. And that's why stock buybacks matter, not as a moral scandal, but as a structural signal. Buybacks allow companies to deploy cash directly into their own share price. They support valuations. They reward executives whose compensation is tied to equity performance. The argument is that buybacks are efficient. The counter-argument is that they crowd out long-term investment. But the deeper issue is this. Buybacks reinforce a system where value is extracted through price appreciation, not shared through income. Dividend yields are historically low. That means investors increasingly get paid only when they sell. So the system requires a buyer tomorrow. Buybacks help create that buyer. And here's the uncomfortable irony. Many executives publicly claim their stock is undervalued, then personally sell into that undervalued market. Companies buy, executives exit. It's legal, it's rational, it's incentivized, but it changes behavior. Instead of building companies meant to last decades, the system rewards strategies that look good long enough to cash out. And politics has quietly adapted to this same rhythm. 2-year House cycles, 4-year presidencies, constant polling, permanent campaigns. Policy becomes performative. Governance becomes reactive. Long-term problems, housing affordability, healthcare costs, labor stability, are acknowledged but deferred. Why? Because solving them doesn't pay fast enough. Now bring missing data back into this picture. When the government can't produce reliable, timely economic data, it weakens the public's ability to evaluate policy claims. It becomes harder to tell whether conditions are improving or deteriorating. Easier to spin, easier to divide. This is how economic uncertainty feeds political polarization, not through conspiracy, but through ambiguity. When shared facts erode, trust erodes with them. And trust is the most underappreciated economic variable. People spend because they trust future income. Businesses hire because they trust demand. Investors allocate capital because they trust liquidity. When trust weakens, behavior changes quietly before it changes visibly. Households delay purchases. Workers hold multiple jobs. Young people delay families. Entrepreneurs hesitate. The economy doesn't crash, it thins. This is why the shutdown story matters more than it seems. It's not about bureaucracy, it's about legitimacy. A government that can't keep its statistical backbone running during political conflict sends a message, whether it intends to or not. The message is, even the measurement system is fragile. And that's dangerous in a high-debt, high-asset, expectation-driven economy. Because once people believe the system is being managed like a narrative instead of governed like a structure, confidence becomes volatile. And volatility always finds the weakest link. Now, is this fixable? Technically, yes. But only if incentives change. Only if long-term outcomes matter more than short-term optics. Only if governance is treated as infrastructure, not leverage. Only if economic success is measured by durability, not just price. That's hard, because the current system works very well for a minority. And systems don't change until the cost of staying the same becomes undeniable. The missing jobs report wasn't the crisis, it was the signal. A signal that America's economic model depends heavily on confidence, debt, and continuous narration. And when narration outruns reality, the correction, when it comes, is never gentle. This is not a call for panic. It's a call for clarity. Because once you understand the mechanism, headlines lose their power, and noise loses its grip. No noise, no spin, just analysis. So here's the question I'll leave you with. Do you think the greater threat to the U.S. economy is an upcoming recession or the slow erosion of trust when the government can't even keep the nation's economic scoreboard running? Let me know in the comments.